Hello everyone, we have to discuss about the GS paper 3. Money, banking and finance sector. Banking system liquidity and for the first time and since May 2019 and the banking system liquidity situation and turns into a deficit and mode of the raise 21,874 and 0.4 crores in September 2022. Reasons behind the recent liquidity and received deficit and in the banking system demand for the capitals by the fintech and there has been other demand for the capital by the fintech and the festival is the pressures and has been the mounting for business to stock the latest trends and the boost their inter inventory to handle the spread in the consumers demand advance tax payment and the surplus liquidity in the banking system and as the measures and by the absorptions of excess fund by the RBI and failed sharply due to the outflows on account of advance tax payment and surplus and liquidity in the banking systems and as the measures by the observer of excess fund and by the RBI fail the surplus and due to the outflows and the account of the advance tax payment and which are the quarterly and phenomenons is creating the liquidities defeats and that also the created the coal money and rate temporary and above the repo rate and features to arrest and rupees and depreciations continued and attempt and the interventions and by RBI in the market to arrest fail of the rupees against US dollar has also contributed to the liquidity crunch. Slowdown in deposits and one of the primary reasons and behind the liquidity and defeat in the slowdown in deposit and growth due to the pandemic and the economic slowdowns and customers are hesitant to the invest in banks and which has led to other decrease in deposit and this has resulted in other decrease in the availability of fund and for bank to lend. Reserve Bank of India RBI policies and the RBI policies also play other role in the liquidity deficit. The central bank has been the mandated other tight monetary policy to control the inflation and which has the resulted in other decrease in the liquidity and additionally the RBI decision to decrease. Decision to decrease in liquidity. Additionally, the RBI decisions to decrease the cash reserve and ratio and CRR and the stated liquidity ratio SLR and effect of the liquidity deficits. Increase in borrowing cost due to the increase in borrowing cost. Delay in loan disturbance and decrease in deposit rate and T-bill rate arise. Increase in borrowing cost due to the liquidity deficit bank have the increased their the borrowing cost making loan and more the expensive for the customers and this has the resulted in higher interest and rate on loan. making it more difficult for the consumers to access credit and delay in loan disturbances and due to the lack of the liquidities bank and have been the unable to disburse loans and on times and resulting in delay for the consumers, and this has the led into the frustrations and among the consumers and who are in the urgent need of credit. Decrease in the deposit rate and bank has decreased and deposit rate to attract the deposit and increase the liquidity, and this has the resulted in lower returns for the consumers on their the saving and investment. Bank will increase and their the repo linked and lending rate and the marginal cost of funds and based lending rates and MCLR, to which all loans are the linked to this rise and will the result in higher interest and rate for the consumers while reducing their borrowing capacities, impacting the demand in the market. And T-bill and rates rise, and since RBI stepped onto the path of rate and the high cycles and treasury and bill T-bills and rates and have the started inching up. Thus the borrowing cost and for the short term papers is expected to increase at a faster phase and compared to the longer tenor security. Financial support to the digital payment. Government of India is the committed to the expanded digital transactions in the Indian economic and thereby enhance the qualities and the strength of the financial sector as well as each of the living for the citizens. And the Union Cabinet recently approved the incentives schemes for promotions of rupee debits card and the low values and Bhim UPI transactions persons to merchant and for other period of 1 year from April 2022. About the initiatives, total financially outlay and raised the 2,600 crores under the said schemes. Acquirings and banks will be providing financial incentives and for promoting point of shell POS and the e-commerce and transactions using the rupee debits card and low values Bhim UPI transaction P2M for the current financial years and FY 2022 and 23. This regime has led to the complaint from the Reserve Bank of India and RBI and banks, and which has been borrowing about the substantively of buildings digital payment infrastructures in the absence of payment and needed to scale and mandate them. The scheme will also promote UPI Lite and UPI 123 Pay as the economical and user-friendly digital payment solution and enables further dependence of digital payments in the country. This incentives scheme will facilitate buildings of other robust digital payment and ecosystems and promoting rupee debit card and the Bhim UPI and digital transactions. Significant of the scheme enhances financial exclusions, digital payment offers anytime and anywhere and access to account, and thus making it easy for citizens to receive the payment in their the account and to also make payment using their phones. Increased transparency in government system and earlier case payments and where the subjected to the leakage payments and that do not. Increased transparency in government system and earlier case payment and were subjected to leakage payment and what that do not reach the recipient in full and the ghost fake recipient and now benefits for are directly transferred and to targeted beneficiaries. Direct beneficiaries transfer account through the digital modes of payment. Instant and convenient mode of payment unlike case money and can be the instantly and transferred to the beneficiaries and account using digital modes like the Bhim UPI and IMPS. Safe and secure digital payments across India are the secures as multiple levels of the authentications and are the required for making transactions and enhances credit access and unlike case payment digital payment and the automatically and is established and the user financial footprint, thereby the increasing access to the formal financial services and including the credit Challenge in digital Challenges in digital payment system in India: risk of the digital penetrations to and mile of the consumers, and while digital payment and have reached other long ways case is the king model still and being followed by various merchant and the consumers. The Sudan's adoptions is yet to be the elaborated and the encourages in various tiers and 2 and 3 and cities to the still and enabled a larger populace of users to be the digitally and the savvy, prone of fraudulent transaction by cyber attack and digital applications and are prone by the cyber attack. Rise of transactions and the futures on digital payment and bank steals and run on legacy and technologies and this then and allow the transaction and which keeps the growing to hit other break point and post which it fell as the transactions failures and hit due to the large numbers of volumes identity fraud and the verifications and while India hosts the largest penetrations of smartphone and user it also the invited a lot of users and to identify duplications for various financial benefits as shorted and digital payment. This provides a lot of the hassle in the identifying the verified and user from the raw data set and in the larger adaptations and on to the whether digital payment and could be other boon or ban. How digital payment are beneficiaries for the economic increase efficiencies and as the digital payments and lead to the enhances efficiency and spread of transactions there is and the induced and cost savings and that the health business and utilized the amount saved in some others areas and where it may the provide great the resulted and reduce cost digital payment lower the cost and increase the securities of lending payings and the receiving money easy they are convenient and easy to use and accountability and transparency because the payment and informations is recorded digital transactions offer improved accountability and the transparency moreover and the additional tracking availability added to the security and hence overall it is help and reduce the corruptions and theft as other result financial inclusions and it helps in the financial inclusions and offers advanced access to the range of financial services bad banks in its first years of the operations, the National Assets Reconstructions and Co. Ltd and NRCL posted a loss of the 5.9 crores and earning some interested from bank deposit and without any bad loans to manage need for other bad loans. The risk of the loan of the converting into other non-performing assets NPA. NPA impacting the financial credibility of the banks. The overwhelming and chunk of the NPAs is lying mostly with the public sector's bank and owned by the government and hence by the public and to keep thus the banks and running the government is sometimes forced to the recapitalized and them using the taxable players and money so that the banks can contribute with the lending and fundings economics activities to set free the banks and from thus the stressed assets or NPAs. The need for the creation of bad banks around and entities and where the straight acid and can be the parked how the commercial banks can resume their the usual business and operations especially lending and the bad bank and would try to sell and thus the assets in the bear market NPA and that bank have the total bad loan in the Indian banking system account to rate 8.35 lakh crores in the March 2021 according to the World Bank data. The shares of NPA to gross loans in India's banking in significant higher compared to the development Western economics. According to the Financial Stabilities Report issued by the RBI, the CRAR of SC BSN increased from the 14.7% in March 2020 and to 16% in March 2021. Concern involved transferring of strength asset from one government entity to another, making no economics and financial changes on the government fiscal burdens and increase the burdens on government exchequers and taxable money. Open up the new topic for discussions on new forms of the socialism for the capitalist, and where the burdens of the bad investment and business decisions of the borrowers is transferred to the taxpayers. Benefits: consideration of the debt and single points and decisions making in insolvency and bankruptcy code IBC 2016, incentives and quicker actions and resolutions, and the better value realizations of bad assets, market expertise, and can be the engaged for value enhancement. Banks will be able to focus on the increasing business and credit growth. The government of India will enhances the liquidities of the security received and SRS as it is being backed by them, and also the SRS and R travels. UPI in finance. Unifeed and payments interfered, and UPI has the super changes India transactions to non-cash payments and by the facilitating direct payments and linked to other bank account, and UPI has been other revolutions and for the entire economy in the large part due to its rapid adaptations. How UPI helping? UPI has accelerated the adoptions of digital payment and made making peer-to-peer payment easier for use cases such as the bills, slips, and money transaction. UPI has been also sub to become other central platforms, and that is the enabling several other the associated finance services and such as the expenses taking, budgeting, and saving and investing. UPI has also increased the financial awareness by offering access to various financial services and investment, making millennials and the gens more knowledge and about their the options. UPI has opened up and many the opportunity for setups and economic players to develop the innovative solution that the elevate the consumer experience. Economic survey 2022 and 23 and India UPI system going global. Bhutan and Nepal become the first to the deploy and India UPI and QR code and the UPI in their the countries respectively. Malaysia merchant trade Asia and allowed spending remittance and to India through UPI. India and the Singapore has announced to link the payment app namely UPI and Pay Now, which will allow the instantaneous and the low cost money and transfer between the two countries. The tease up bill benefits and the Indian economic on three major ground, helping India becoming more integrals and to the globalized economy, supporting the fintech ecosystems and better the foreign and remittances and many more. New monetary policy tools in banking. Monetary policy is the bedrock of the any nations and economically policy, and everyone from the part-times and workers to hug financial institution and both foreign and domestic are the implemented, and is it's the shift. What is the monetary policy? RBI monetary policy is other collections of the financial tools and measures to safeguard and the promotes economics growth, and according to the RBI it's the conduct monetary and policy and with the primarily objectives of mandating price and stabilities, and while keeping in mind the objective of growth. Monetary policy review are among the most effective tools of the central bank of many country to the achieve financials and the stabilities and economically growth. Monetary policy basically control the overall supply of money available to commercial banks and the indirectly to individuals, users, and companies. Objective of monetary policy: to promote saving and investment, to control import and export, to manage business cycles, to regulate aggregate demand, to generate unemployment, to help with the development of infrastructures, to manage and development of the banking sector. Monetary policy tools: repo rate. Repo rate is and the interest rate at which the reverse bank provides liquidity to the commercial bank against the collaterals of government and other the approved security. Reserve repo rate: the interest rate at which the reserve bank and observe the liquidities and from the commercial bank against the collateral of government security. Variable reverse repo rate and the rate at which the RBI issues and loan to the commercial banks, and when there is other short of the fund is the repo rate, and it's help to control the inflations. The reverse repo rate is the variation or fixed interest rate and bank lend to the RBI. Standing deposit facilities: bank rate or marginal standing facilities, MSM, liquidity and just facilities, and case reserve ratios, and CRR, stated liquidity ratio, SLR, and open market operations. Standing deposit facilities: standing deposit facilities is and the overnight on deposit facilities that allow bank to the park access and liquidities and money and the earn interest, and this is much more efficiency and then the reverse repo rate arranged, and whereas the G sect had been to sold and repurchased to the observe liquidities and the pay interested no sell repurchases. Bank rate: the rate at which the reverse bank and agree to the purchases or the rediscount and bill of exchange or other commercials and papers, and the banks rate act as the panels and rate and changes on the bank for short fails in meetings, and there the reverse and requirement, and such as the case reverse ratio and the statutory liquidity ratio, and bank rate is the closely linked and with the marginal standing and facilities, MSF, and rate, and thus the changes as and when the MSF rate changes, marginal standing facilities, MSF rate, and the rate at the which and commercial banks borrow on in the overnight basis from the Reserve Bank of India, and liquidity adjustment and facilities, LAF. This rate and refers to the reverse bank operations and through which it the injects or such and liquidity into or from the banking system. Apart from the LAF and other the instrument of liquidity management are opens market operation, OMO S, and forex swaps, and the market stability skills, MSS, case reserve ratio, CRR. Refers and to that the percentage of the bank total deposit and which it is the need to be to maintain as the liquid cash, and this is the mandatory RBI requirement where the case reserve is kept, and with the RBI a bank cannot earn interested on this the liquid cash. It is the mandated and with the RBI, and also cannot use this the deposit for the investing and lending purposes. Stated liquidity ratio, SLR. Stated liquidity ratio is and the obligatory research on all that all the commercial banks in India are the required to mention by themselves in the forms of liquid cash and gold or other the securities. This is the minimum requirement, and that the banks and acceptance to keep the before offerings and credit to the consumers. Open market operation, OMOS, and refers to the outright and purchases and sale of the government security and bond or the treasury bills and T bills, and by the reserve bank, and either for the injections and or for the observations of liquidity in the banking system. Sovereign green bond: India debuts in the green bonds and market about the green bonds. A green bonds is other debt security and that is issues to other raise money for initiative that are the relevant to the environment or other climate. Government offers sovereign green bond to be raise money and for thus the kinds of the initiative the government of India joined the sovereign green bond clubs on 25 January 2013 when the Ministry of the Finance priced as INR 18 billions and for the expenditures in grid scale solars and the wind and decentralization solar such as the solar water pumps and for agriculture green hydrogen and metro lines and the afforestations. Rationale behind issues and of the solar of sovereign green bonds and hedge against the climate changes as per the World Banks and green bond offer the investor a platform to the engage in good practices influences the business and strategy of bond and issues and they provided other means to hug and against the climate changes and risk while achieving it the list and similar if not better return on their the investment attractive to issuers and they comes with tax and incentives and such as the exemptions and the tax credit making them other more attractive and investment wells are the comparatives and taxable bond achieving net zero emissions the issuance of the sovereigns and green bond is in consonance and with the India visions and to the achieve net zero emissions by 2017 and which has been carefully considered after taking into the account the principle of United Nations Framework Conventions on Climate Changes and UNFCCC and in the light of national circumstances attracting global and the domestic investment and the proceed and generated and from the insurance of the such bonds and will be deployed in the public sectors projected blended finance for the climate actions and sovereign green bonds and the thematic and funds for blended finance in areas and including the climate actions and where the announcement in the union budget in 2022-23 and the budget uses and energy and transitions and by encouraging domestic productions of solar powers equipment and varieties in the line and with the Indian climate community commitment positive environmental and climate benefits as per the Securities Exchange Board of India and SEBI Green Debt Security are created to fund the project and that have the positive environmental and the climate benefits reduced carbon intensities and India has the pledge and to the achieve cumulatives and the installed and capacities of electric power from the non-fossil fuels and based energy resources of about the 50% by the 2013 and to reduce the carbon intensity of its economic by the 45% and from the 2005 level by that time implications of sovereign greens bond for other developing countries like India encouraging private sector participations the insurances of sovereign green bonds and can the encourages private sector participations in financing environmentally sustainable project and this can increase the availability of capitals and for such the project and promotes the development of other green finance ecosystem and attract more investment and in the Indian domestic market for fosterings and innovations and sovereigns and the green bonds can also foster innovation in the development of new technologies and the practices and that promotes sustainability and this can lead to the creations of contributes and to the growth of the Indian domestics market in a sustainable manner and promoting international corporations the issues of the sovereign green bond and can also promote the international cooperation in financing sustainable development project and this can lead to increase the foreign investment in the Indian domestic market and promote the transfer of the technology and knowledge and for the development to the developing country and enhancing the transparency and the accountability and sovereign green bond and can enhance transparency and accountability in the issue use of funds and which can the improve government and promote the sustainable development contributing and to the climate changes in mitigations, and sovereign greens bond and can also the contributed to the climate changes mitigations by financing project and that the reduce and greenhouses and gas emissions and promote the sustainable energy sources, and this can help India to meet its climate changes and commitment and the reduce its carbon footprint, and while the promoting sustainable development stock municipalizations accounting fraud and the corporate governments. Hindenburg, a US-based investment research and firm that specialize in the activism and short sellings, and said it's the 2 years investigations and revealed that the raised 17.8 trillions and the 218 billions and Indian conglomerates and the Adani groups and has the engaged in other brazen stock manipulations and the accounting fraud and schemes over the courses of decades, and fundamental stock manipulations. Stock market manipulation is conduct or technique used by the stock market entitled to the full or the investment